You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again at OptionAlpha.com, working every single week to make this the most popular investing podcast offered online and in iTunes because it's based on one thing and one thing only, and that's helping you guys make smarter trades. So again, thanks so much for tuning in today. On today's show, we are going to be talking about how you can pick the right option strategy for wealth building. And basically, it's just this whole conversation about how to choose the right strategy, the right setup, etc. And I still think that many people are getting this way too confused. And so hopefully this podcast today, as we kind of go through an example and use some of the research from our backtesting and our profit matrix, will help you kind of understand why this has to be a dynamic approach now. And we talked about this before in the past about how you can't just use a single-legged approach, meaning you can't just do the exact same thing every single setup. You have to be more dynamic in the markets now because, well, frankly, we just have more data. And so, for us, it's a mind shift change that we've made. It's not necessarily a whole new strategy, but we are tweaking the way that we enter trades, and for the better, I believe, and ultimately will lead to either A, more consistent returns, or B, or A and B both, higher profits, which is what the whole goal of doing the research and building out the software was. Now, before we actually get into the show, as just a quick little sneak peek or little teaser, really, we're going to be releasing very soon, and I don't have a specific date yet, so just check your emails or watch out for it on the website. But we're going to be releasing very soon our new daily podcast called The Daily Call. Now, I'm not sure if by the time that this goes live in iTunes or online, if we'll actually have that up and approved yet by Apple. Sometimes it takes a little bit for those to get approved, but we do have about 30 episodes that are already in there. So basically about a month's worth of content that's kind of slotted and scheduled. Most of them are recorded for some little shows that we did. But again, it's a more hands-on approach to just daily nuggets of information for trading. The weekly podcast that we do here is not going away. We're still going to do it because we do a little bit longer episodes, more in-depth case studies, etc. And I do like doing the trader Q&A calls as well as the closing bell segment where we talk about actual trades. But I think you guys will really enjoy the daily podcast. I've actually enjoyed recording some of those episodes because although some of them are pretty short and to the point, which is what we wanted, we didn't want an hour of your time basically every day, but a little bit of information every single day, and they're mostly on trading, but also on trading psychology and motivation and self-improvement type stuff. Just any little tidbits that I think are really helpful and can kind of get you to the next level. So like I said, I've been enjoying recording those. I've got a lot of questions, a lot of topics slotted for the next year or so on that. So I think you guys will enjoy it and just be on the lookout for that. All right. So on today's show, like I said, how to pick the right option strategy. I think to start, I think there's a big misconception in the market. And we talked about this on the previous episode, but it's worth just mentioning again if you haven't listened to show 102. But there's a big misconception that cheap premiums and limited profits lead to small returns, right? And I see this all the time, right? People say, like if we ever close a trade and it's like, say a, $200 loser, they'll say, see, Kirk, right? Like a $200 loser. Now these big losses start to overshadow the small winners. And the end result is that they never do. It's not really ever the case, right? You still have to make lots of trades for this to work out, but the small winners will never be overshadowed by the big losers. It's just like insurance. It's just like the casino analogy, right, that we use. It's how casinos and insurance companies make money. They basically write contracts on lots and lots of small bets, and they know that they're going to pay out some big, hefty payments here and there throughout the year, right? But it's never going to overshadow their core business. It's never going to rock them to the core so that they end up generating less money long term, right? And so we want to run our options trading business in very much the same way. Now, that being said, limited profits and what looks like small returns do add up as long as you're optimizing your trades now for the right setups. So what most people do is they just blanket trade the same delta every single time. And I think that that's the wrong approach now. And what we've definitely suggested and done lots of coaching and strategy calls on with our elite and pro members on is that our approach now should be much more dynamic. Ever since we started getting in a lot of data on, what works and what doesn't, we have to now make different decisions based on different market scenarios at the time. I often relate this to real estate, and I think about it in real estate because my wife and I do a lot of real estate stuff. And it's like looking at a piece of property and always saying that you're going to flip the house, right? That's what most people are doing in the trading business. They look at a trade and they place the exact same trade every single time, right? And while that's okay, while that can generally lead to profits, I'm not saying it couldn't, is probably a better approach. Maybe one house, to use the real estate analogy, one house is better to be rented out and, fixed up and rented out. Maybe that's the best approach for that house. Maybe another house down the street is better to, renovate that house and flip it and try to, generate a profit. But I don't think that there's one exact approach for every single house out there, right? And so that's what many people are trying to do. They're trying to force their same approach that they've learned, whatever it is, on the markets, and without realizing that you have to be more dynamic. You have to kind of tweak and adjust your settings based on the market parameters. Okay. And so I know that that's a high level picture of what we're talking about, but hopefully that like concept makes sense as we kind of get into, some of the case studies that we'll look at here today. So as far as general steps go, here are the general steps for picking a trade or picking the right strategy. And I honestly think that people still confuse us. So it's like when I even wrote these out, I'm like, there's not even really that many steps, but okay, we'll go through the steps so you guys understand, the framework that we're going to follow. Again, it's a framework. It's not an exact, you have to do this, then you have to do this, right? It's just a framework. So the first thing is, I think you have to start with liquid stocks and ETFs. We talked about this ad nausea since probably episode number 3 of the podcast. You can't focus your time on stuff that's not liquid. And so a lot of people have asked before in the past why, when we released our trading software and our backtesting stuff, why we limited the scope of the tickers, and because we wanted to only test and only have available the most liquid stuff out there. And so I don't care to trade, say, ticker symbol GOOD. I always use that one as like a guinea pig, but a company called Good, right? I don't want to trade that because it doesn't have liquid options, right? So I don't care if it's the best setup in the world. I don't care if, every technical analysis indicator aligned perfectly. There's no point in doing that because it's not liquid enough. It's not going to generate enough consistent returns. It's not going to generate enough consistent trades. And we don't even know how reliable whatever, pricing is there because not a lot of people are trading it, right? So if one, dummy just, overpays for an option contract, does that mean that that's now the best, opportunity? No. But if we have something where we've got thousands of people trading or hundreds of thousands of people trading contracts, we can be a little bit more sure that the option pricing is what it is, right? And that the spreads are pretty tight. So that's the first step. Just pick a liquid underlying stock, right? Now, here's where I say it really is ultimately up to whatever you want to do at this point, right? So step number 2 is pick whatever stock you want and pick a direction. Now, I say that with all, I guess, humility in the sense that I think people like focus on this step more than any other step, right? And maybe rightfully or wrongly so, but here's how I think about it, about picking a stock and then picking direction. Number 1 is that whatever stock you end up choosing or ETF, so I'll say stock for the rest of the podcast just because it's stock or ETF, whatever security you end up choosing. The only question you should really ask is this security good for my portfolio? And the deeper meaning of that question is, if I've already got 10 trades in oil-related ETFs and stocks, do I really need another one, right? And what you're trying to generally do is just get a good mixture of underlying securities. Now, there's no perfect mixture, right? But if you're trading Facebook and Twitter and Snapchat and, Google and Microsoft and Apple, you've got a lot of exposure to tech. Now, do you want that in your portfolio? Maybe you do. I don't. I don't want all my exposure into one area or one, subsector of the economy. I want to have, and members know this because this is how we generally build our portfolios, but I want to have things like, currency ETFs. I want to have some commodities, whether that's oil or gold or both. I want to have exposure to bonds, to foreign markets through EFA and EWW and EEM. I want to have exposure to maybe like China, to the regular US markets through the Dow or the Qs or IWM or the SPY, et cetera, right? Like I want to have a broad width of securities in my account. Now, this is where I start looking for trades. I always go top down, highest volatility first, right? And then work my way backwards. But you have to start asking yourself just like, what's a good mix for your portfolio? Again, there's no perfect answer, but what's good for you, right? Maybe you can only do 5 different ETFs. Maybe someone else can do 15. That's ultimately a personal decision, but you have to kind of have some guidelines or things that you look at on your end. Now, once you actually find a ticker that you want to trade, and it ultimately doesn't matter at this point, right? So choose whatever ticker you want. As long as you're not over allocated in one area, I think you'll ultimately be okay. And you have to pick a direction. Now, this is again where I think people get like analysis paralysis. I generally think, and I generally trade neutral, meaning that I don't pick many directions for trades. That doesn't mean I don't pick a direction ever. We recently have done trades where we have gone bullish on one thing and bearish on another, right? But ultimately, most of the trades that we do are neutral in the way that they're created because I don't know where the market's going to go, nor do I care. I would rather just see the market trade within a range and I, basically have this window to catch the market in and be able to profit, whether it goes up or down or sideways or whatever the case is. This is where you can, if you want to, use some technical analysis. Whether you use the technical indicators that we released as part of the signals package, or you use your own, you use moon signals, eclipse signals, right? Whatever you want to use as far as your indicators, it doesn't matter at this stage, but you have to pick a direction, right? Once you have your security, you've got to pick a direction and choose. Are you bullish? Are you bearish? Or are you neutral, right? And just pick one. And ultimately, like we said, as long as you're not too much of one thing, right? You're not too bullish or too bearish, I think you'll be okay. And you can be all neutral, or you can be neutral, bearish on some, bullish on the others. Just have a good mix in your portfolio. Know what your portfolio needs, right? That gets back to what we talked about, I think in a couple episodes ago, where we talked about beta weighting our portfolio and making sure that it's pretty neutral to the market. This is where this all kind of ties into, right? So once you actually pick a direction, and you got to pick a direction, the next thing is you've got to find the implied volatility level, right? So now the next thing is to find implied volatility level, which is pretty easy to find on most broker platforms. If you use Thinkorswim or Tastyworks or any of those guys, you can find implied volatility ranking or IV percentile levels. You've got to find that. If you don't use those, or if your broker doesn't have it, pick up a copy of our Toolbox Lite software. It's $47 for lifetime access, and it has all of that stuff in there for you. So it tells you IV levels in there. Again, this is where we kind of find our ETFs mostly as we sort our watch list every day, highest to lowest implied volatility. We try to take the low-hanging fruit, meaning the highest implied volatility setups first. From there, you've got to pick a day to expiration timeline. So how far out are you trading, right? So at this point, we've picked a liquid stock. We've picked a direction, right, that we're going to trade. It's a good, security for our portfolio. We know what implied volatility is, and now we have to know where or how far out expiration is. Is expiration 20 days out, 30 days out, 40 days out, 50 days out, 60 days out? What expiration timeline are we going for? And the reason that we do this is because now this last step that I'll talk about here in a second requires that we know these few things about the market before it can tell us what to do, right? That before we know exactly what type of strategy to put on. And so we have to choose a contract month. And this includes if you wanted to do weeklies. If you want to do weeklies, great. And, choose how far out you are from expiration for the next week or 2 weeks out, or however you want to do the weekly expiration cycle. Okay. But the end result here is you got to figure that stuff out. Now, everything that we've said so far is pretty much, most of it is given information. You can find the days until expiration. That's given. There's no subjective nature to that, right? Unless we're in between contracts, and then you just got to choose which one you want to go with, the front month or the back month. You got to find the implied volatility. That's given. There's no subjectivity to that. You have to pick a direction, which I think is given as well. There's no subjectivity to that other than if you have technicals. If you have technicals, they should be able to tell you generally if you're in a market that's oversold or overbought. And if you just flat out don't know, pick neutral, right? And then liquid stocks and ETFs, that's probably the only place that you have some subjectivity where you can choose what mix is in your account, what you need versus what I might need at a given situation, right? So if I don't have any exposure to tech, maybe I go looking for a stock, that's in the tech space, and you've already got a bunch of tech type underlyings, right? So again, you have to use a little bit of just rational thought here on that end, okay? But now that we have all these things, what you have to do is you have to plug it into our optimizer. Like, I don't know what other way I can, help describe this other than just saying like the optimizer is exactly what I use now for all of my trades. I plug in the direction, I plug in what type of account I'm trading in, and I plug in what factor I want to optimize for, meaning like what am I concerned about? Returns or Sharpe ratio, which is basically like portfolio stability and returns kind of baked in together. And I plug that into the optimizer, and then it spits out and tells me exactly how to set up that trade for a given ETF at that IV level at that day's expiration. So to use some concrete examples, and I think this will help because I think many people here could trade an Iron Condor if you wanted to, right? It doesn't matter if you're in a margin account or IRA account. An Iron Condor is a favorite strategy of people to trade. Well, I plugged in two different scenarios for an Iron Condor just so we can see what the best setup is for these two scenarios. And I think that this is important because it shows that in different market situations, you might have different stock setups, or strategy setups. And this is where that dynamic approach starts to come into play, where it's not always just, hey, place the Iron Condor, 6 strikes above the market and 6 strikes below the market. You've got to be dynamic in your approach based on whatever the market situation is. Okay. So here's what I did. So the first one is an Iron Condor, 40 days until expiration, right? 40 days until expiration with IV rank at 50. So if we have IV rank at 50, which is generally high implied volatility, and we're 40 days from expiration, then the best setup for an Iron Condor is to sell the short strikes at a 20 delta with $10 wide wings. There you go. It literally spits that out and tells us that's the exact best setup for that given situation, right? To basically do this short strikes, 20 deltas and $10 wings. There's no subjective nature to this now with the software that we built. So you can basically go in and tell the system what the market situation is, and it spits out and says, okay, this is basically what you should do. Now we give you a list so you can kind of pick and choose, and we give you the top 10 so you can hone in on this if you want to, right? But that's what it ends up doing. Now, if I make some changes to how far out we are until expiration or implied volatility rank, so maybe I'm looking at a different security, right? And I want to now trade a little bit further out. So I still want to do an Iron Butterfly or an Iron Condor trade, but maybe I want to go 60 days out. And on this new security, implied volatility is now 25. So if it's 25 rank versus 50, and I'm 60 days out versus 40, now the system tells me that the best setup is to sell the 25 deltas on each side and have a spread width of 15 strikes wide, right? So that may be counterintuitive. You may not think to yourself like, why would I do that? But that's of all the testing that we've done, of thousands of variations that we have, of hundreds of tickers that we've tested and run these scenarios through for 10 plus years of data, that's the best setup at that given moment. For 60 days out, an IV rank of 25, right? One of the best setups that you can do is a delta of 25 on each side and spread width of 15. That's totally different than if you are 40 days out and have implied volatility rank at 50, right? And this is why it's so important, because just this little nuance here, this little change in delta can cause a dramatic shift in your profitability. Dramatic. But it's not like we're changing, and this is what I talked about earlier. It's not like we're getting away from selling options between one contract expiration and another, between one implied volatility rank or another. It's that we're just tweaking it just enough to really, really optimize what we're doing. To go back to the real estate analogy, maybe one house that you look at if you're thinking about, investing in real estate, that house might be just that much better, flipping versus another house might be just that much better as a buy and hold rental, right? That's the type of tweaks that we're trying to do here to our strategies as we continue to evolve this. And so a lot of what you should be doing now is not a lot of guesswork. I mean, that's literally why we built this. Now, I know we've talked about the software that we have, and that's hard because people are, you might be thinking to yourself, well, Kirk, you're just plugging your software. And I'm plugging it because it's really freaking good. And we built it with the understanding that this helps solve a lot of problems that many people have with regard to how to pick the right option strategy. There's no guesswork involved here anymore. And we tried to make it as valuable as possible because all it is a couple $100 one time, and then you get lifetime access to it, which nobody else does in this industry, because we wanted it to be something that everyone could afford to get and pays for itself in literally like 3 or 4 trades, right? That's why we're doing this. So hopefully this podcast has been helpful in just kind of understanding the thought process that we go into and kind of building out these trades, right? But the end result here is that if you really want to do this on a professional level, you've got to start building your trades based on these little tweaks and optimizations. Now, you could take today's podcast, and if you don't want our software, that's totally fine. I understand. Look, you can do whatever you want, right? You can then take whatever information you learned today, and when you get to the point of actually choosing how far out to go until expiration, use some general guidelines if you want to, right? Maybe between 40 and 60 days out, you generally do the 20 to 25 delta, right? That's a general guideline. Spread width, generally 10 to 15 strikes wide, right? There you go. There's a general guideline that you can use, but somewhere in between there, depending on what ticker you're looking at or where implied volatility is, it may not be the ultimate scenario. It may not be the ultimate case. Now, here's something I'll also tell it because I missed this in the beginning and I just wanted to, or as we were starting to talk about this. The Iron Condor in this case, as we're kind of optimizing for this in both of these scenarios, was fairly profitable across the board, right? So most of the average annual returns were positive, right? For these higher optimized levels, right? Which they should be. But the differences between the stuff at the bottom end of the spectrum, like when I look on my end of, like let's say the top, 50 optimized Iron Condors, right? The ones at the top versus the ones at the bottom had almost 2x improvement in returns by just simple tweaks. I mean, literally simple tweaks, right? You're still setting it up generally the same, but little tweaks to when you exit versus when you don't, how wide your spreads are versus not, the deltas that you sell versus not. I mean, little tweaks can cause a 2x improvement in your returns. And I think that that's important information. That's why I set out on a mission to kind of get this information for myself like 2 years ago almost now, because I wanted to know like, hey, what is the most optimal level to sell, an Iron Condor at right now in today's market situation, 40 days from expiration versus 60. That's the type of information that we have now available. And it would honestly be to some degree like crazy for you not to want to get that type of information for your trading because it helps smooth and streamline the entire process. Okay. So again, like I said, hopefully this podcast helps. I know we talked a lot about obviously our software that we have, which you can learn more about at optionalpha.com/toolbox. But either way, I think just getting over the analysis paralysis for getting into trades is the big hurdle that you have to cross here. I think way too many people think too much and too hard about the ticker. They think too much and too hard about the direction. And ultimately, they're small bets. And so you just have to play small bets and learn along the way and make sure that you just stay balanced. And that's really, something that you just have to learn as you go. It's not something that's always 100%. It can't be a final destination. Balance and neutrality is an ongoing thing. As you remove one position, you now have to rebalance maybe for the next one, right? And that's something that just constantly evolves. And so it's a hard concept. I get it to kind of master at first, but it's really, really important to start looking at. So hopefully you guys enjoyed this, and we'll get into now the Trader Q&A segment.
And now our favorite part of the show, Trader Q&A, where we ask a question from one of our current members about options trading. Got a question you'd like to ask Kirk to answer live on the air? Just head on over to optionalpha.com/ask and hit the record button to leave a message. That's optionalpha.com/ask. And now, here's today's question.
Hi Kirk, it's Lulu. I am in Sydney, Australia. I attended the webinar this morning. My time 6:00 a.m. was half sleeping really. My question to you is that I'm brand new. So treat me like a child, has no knowledge, no experience at all. So I need to know, how do I start, and how do I get a platform to try, and what basics I need to know. I have no knowledge even what means by put, call, or all those terminologies, or the words that you use in the webinar. Just a little guidance that I needed. Thank you, but I will keep learning. Thanks.
All right, so thank you, Lulu, for submitting your question from down in Australia. So really, it's all about just getting started with no knowledge. I think that's really the gist of the question, as you said. And so to treat you as a kid, as you said, or as a child and getting started, I think the first step for anybody getting started with trading options, I would say, is to go through our free tracks that we have. And look, you can go through anyone's education. So I say ours because I think it's great. And I know a lot of people have gone through it and it's very helpful. But there's tons of resources out there that are free on options trading that you can just search online. But I would say get the basics down, try to understand the terminology at first. That's always the biggest hurdle, is understanding terminology. Once you understand the terminology, like what is a call, what is a put, what does it mean to sell a call versus selling a put, like all of that stuff, then I think, all of the concepts start to slowly fill in the gaps and fill in the spaces in between. So I would suggest going through track number 1 on our website, which is the beginner track. It literally takes you start to finish. We've also got some courses on just options basics. So if you just want a refresher on options basics, we've got a course completely on the basics of all the different aspects and terminology: calls, puts, strike prices, expirations, you name it. That's the best place, I think, to start with. And after that, I would start then building on those options basics by learning simple strategies. So the next step in anybody's education is to take that foundational element or that foundational learning of options basics and terminology and start slowly building onto these more advanced strategies. So spreads, etc. Start building up to naked positions and, butterflies and ratios and things like that. But you want to take it slow and kind of build and progress forward. So hopefully that helps out. And again, thank you for submitting the question. Now, remember, if you have a question that you want to get answered here on the podcast or live on Facebook and Periscope, or really a question for our new daily podcast that's going to be coming out soon called The Daily Call, head on over to optionalpha.com/ask. That's where I'm taking all of the questions for those. So it's first come, first serve, and click the big red button in the middle of the screen and leave me a private voicemail. It goes directly to me, nobody else. There's no software to download or install, and it's incredibly easy. Now, again, before we get into the closing bell segment, if you want to learn more about our options, backtesting, and trade optimization software that I mentioned, just head on over to optionalpha.com/toolbox, and you can check out some demos there. Also, a quick little video walkthrough.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so in today's closing bell segment, I want to talk about a new trade that we got into in FXI. FXI is a China ETF. This is part of, again, just our strategy for just having a lot of diversified ETFs and stocks in our portfolio. So FXI is a China ETF and has actually been on a little bit of a run lately from 41.5 up to about 44.5. So it's actually made quite a little bit of a jump, and we want to get into it. It's got higher than average implied volatility. So implied volatility rank is up around 41, 42 right now. So definitely higher than where it's been in the past. So like the last year, implied volatility has been pretty low in China, but now this ETF has seen some higher implied volatility. So it kind of came up on our watch list today as we kind of sorted that watch list and looked for trades. And so we want to get into something. Now we're going to build something out in October, which is about 52, 53 days out from the time that we're recording this podcast. And so literally all I did was plug in, the basics of this trade to our optimizer like we talked about in today's show. I plugged in the IV rank. I plugged in how far we were until expiration. And then it gave me a setup for this strangle as being the most optimal setup. So in this case, we ended up selling the 41 calls and the 47 calls and the 41 puts for a $64 credit each. Now, as always, we try to ladder into positions. So this is our first position for October. It's kind of like the first 2 posts that we stick in the ground. And we are going to then add more to this position as FXE moves in the future. Now, if FXE doesn't move, right, then we'll just continue to hold this thing. It'll decay in value and we'll close it back out for a profit. But right now, we're going to shoot for, in this case, about a 50 to 75% profit target on this. That's what the optimizer suggests as being a good profit target for this. And of course, if you're doing an Iron Condor and you want to convert this strangle over, then you'd probably look to buy the 37 puts and the 51 calls. So buy options out on either end about $4. That looks to be about the best area, not only for liquidity for those strikes, but also just so that you don't buy options too far out and not really get any benefit from them, right? So we always take a look at that, and we always send that out in the alerts as well. But again, it's just a trade. It's just the first one. It's getting us some more exposure to FXI for October. We've already got a position for September. We've now started to build out the October portfolio, and we're just going to continue to monitor this and start adding new positions. Probably maybe another 1 or 2 sets of strangles here before we're actually filled with October expiration, and then again move on to November if implied volatility is high. But hopefully this helps out. Again, we're neutral on FXI. Don't have a directional assumption. There's no technicals that are flashing right now that would tell us that it's either overbought or oversold. So it is trending up, but we're generally going to play this thing neutral within this $47 to $41 range, which I think will work out.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so I truly hope you guys enjoyed today's show, and as always, got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. As always, you can get additional resources, links mentioned in the show, and some related video training on how to find trades, how to pick strategies, etc. by going to the show notes page at optionalpha.com/show 103. That's just the number 103, optionalpha.com/show 103. Until next time, happy trading.